Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So volatilities may revert back to their past price, the mean. That's the definition of the average price, the mean. So volatility is normally changing. And we had a question on the time frame. What time frame do you use? The question is, will it revert? So great questions on that time frame. And again, there's no right answer. Investors can use their own methodologies to make a prediction on these currency values. You can use technical, fundamental, or any other style. Investors can select the option strategies that are best suited for them. And these models will help augment their decision-making process. But again, you're going to have, there's no right way to trade this. Hopefully you come up with a methodology that makes sense for you. You might want to create a system. Some investors do, some don't. No right or wrong answer there. Most important thing, are you bullish, bearish, or neutral? And what time frame are you expecting? If you're making a market prediction for the next hour, you're probably, quite frankly, better off trading the spot market. Because again, if you look at the options market, the bid-ask spreads are going to be 7-8 cents wide. I think that's very reasonable when you're making a prediction out for many, many months, even maybe a month. But if you're trying to make a prediction out for the next hour, well, you might be better off in the spot market. As I said, there's they discuss informational value, and I'm going to talk more about informational value and skew in the future. What is hedging? Get this question all the time. Should somebody be hedging? Again, that's a personal question. That's up to each investor, but you can use options to hedge your exchange rate risk if you'd like to. Options can be used to either reduce risk or increase risk. It's up to you. So options are not good or bad. They allow the transfer of risk. And I think they're good in that reason, in that rationale, but looking at it from a leverage standpoint, leverage is a double-edged sword. Some investors say to me, Steve, I love trading the spot market because I can get 100 to 1 or 1,000 to 1 leverage, what have you. They think that's great. Well, I don't know if that's necessarily great. All that really means is you're able to take more risk. So the options market, you can buy out of the money options if you'd like more risk. Doesn't necessarily make it a better trade. You can trade spreads with less risk. And I quite frankly think that might be a better way to trade for a lot of us. The option Greeks, and I'd urge you all to come back on option Greek class will be coming up very, very soon on February 18th, talking about delta, gamma, theta, vega, and rho. When I'm talking about these Greeks, I'm talking about quantifying risk, quantifying changes in the underlying rate and how much the option will move, delta. If there's a gap, how much my delta changes, because delta does not remain the same. How much, when I buy an option, I'm buying premium. I'm buying some amount over that intrinsic value. So how much of that is going to decay each day? What about changes in volatility? That's called vega. And then rho, that measures interest rates. Why would somebody buy a call option? Well, they're bullish on the underlier, obviously. But the biggest benefit is they like this. Limited risk if they're wrong. That's the biggest benefit of a call option, excuse me. That's the biggest benefit. If you sell a call, what's the biggest benefit? You like the premium. Nothing happens, you earn that premium. Of course, the disadvantage is if the asset moves up, you lose point for point. So in every trade, you need to think of the advantage and disadvantage. Buying a put, why do you people that want to buy puts? They like, if they're wrong, they have limited risk. And if they're right, well, they have substantial profits. If you sell puts, what are you in? You're in that strategy because you're trying to earn the income. Options are about probabilities. So the most likely place for an exchange rate is where it is today. That's based on theory. More than likely, the exchange rates are going to move a bit. But according to theory, we're going to stay right where we are. So we might not agree with that. Let me use an example of coin tossing, and I hope this hammers the point home of what a market maker, it's a great metaphor of what a market maker does. Because if you have a coin, it's a 50-50 probability, up or down. So if I said to all of you, what's the probability, if I threw 4 heads, what's the likelihood of it? Well, you could do the math, and essentially it comes out to be 1/16 of 0 heads or 4 heads. So what's my payoff? It should be, that's going to happen 0.0625, right? Because it's the 16th. So I could actually make markets based on that probability. So if it's only going to happen 1 every 16 times, well, I don't want to pay that much for it. I don't want to pay more than that. In fact, what a market maker would do is pay a little bit less, try to sell it a little bit more. And they would do that for every one of these outcomes relative to the probability. Probability might be 25 cents, and they might say, all right, 23 cents bid at 27. We might have a 37-cent probability, 35.40, and so on, and so on. The key point is that they're trying to buy under that dollar valuation and sell over the dollar valuation. But, and this is a key but, they do not want to sell any one forecast or any one expectation in too big a size. So if too many people start to buy this prediction, what will happen? These quotes would go up, right? They would move from, let's say, 5 cents, 8 cents to maybe 9 cents, 12 or 13 cents. Even though theoretically it might only be worth 6, they're going to raise the prices because they don't want to take too much risk. If everyone decided they want to sell that option, the probability might still say 6 cents, but it might go down to 2 cents bid at 4 cents or 2 cents bid at 5 cents, something like that. So market makers are going to balance their theoretical prices with actual prices. Most importantly, what happens, your plan B. What are you going to do if you're wrong? That's important. So let's look at the ISE pair value at 91. By the way, I think this is AUM at a couple weeks ago. So the 91 call might be 208. The 3-month might be 297. I'm sorry, the 3-month call might be 208, and the 3-month put might be 297. The 1-month call might be $1.24, and the 1-month put might be $1.55. So it's a 50-50 probability. Remember I talked about the interest rate diff? That's why the puts are trading much higher than the calls here. Because if we're right at the strike price, according to theory, they should be worth the same, but because the interest rates are higher in Australia, the puts tend to be a little bit higher than the calls. So the 91, 96 calls can be shown in different months. And you'll see that the 1-month 96 is virtually worthless, only trading at 10 cents. But if you move out to the 3-month 96, it's worth a lot more. Why? Greater time gives a greater probability of success. And the 1-month 96 trading at almost its intrinsic value. If it's trading 91, the 96 put's worth about 5, and it's trading a little bit over that. So this is sort of how you'll understand how these option orders are going to affect the prices a bit.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.